Hi, good morning, everyone. This is Graham Norris here. Today is September the 11th, and today I thought I'd cover the subject of falling interest rates in a multi-family real estate investing market and yeah, go over some ideas, things that we need to look out for. So, welcome back to this channel. Today, we're going to talk about something that could be a game changer for real estate investors this coming fall. Falling interest rates. What happens when interest rates drop, and how does it affect multifamily syndications and rental rates? If you're in the business of investing in multifamily properties, or just curious about how these shifts impact the market, stick around. We've got a lot to cover today. Interest rates are essentially the cost of borrowing money. And when they fall, it gets cheaper for everyone to borrow, including real estate investors who want to buy multifamily properties. But how exactly does this affect the market, especially in terms of property values and rental rates? And rental rates especially. Today, we'll break down the impact of falling interest rates on multifamily syndication in three main areas: property valuations and cap rates, financing costs and investor returns, and rental rates and demand dynamics. Let's dive into each one. Let's start with property valuations and cap rates. I did an earlier video on cap rates, but when interest rates decline, cap rates often follow. For those who are new here, the cap rate or capitalization rate is the ratio of the property's net operating income to its purchase price. Lower interest rates generally lead to lower cap rates because borrowing is cheaper. This usually results in higher property valuations since more investors can afford to pay a premium for assets. So what does this mean for syndicators? Well, properties become more expensive, but because financing is cheaper, the deals can still work out favorably. For those in the market, lower interest rates can mean more competition for properties and potentially higher prices. However, for savvy investors, it could be a great time to lock in low-cost debt and capture appreciation as rates continue to fall. Second thing is financing costs and investor returns. Lower interest rates directly reduce financing costs. For a syndicator, this means lower monthly debt payments, which improves cash flow from the property. With better cash flow, there's more room for higher returns to investors. Plus, with cheaper debt, syndicators can leverage more while still maintaining a comfortable debt service coverage ratio, which is the DSCR, which lenders look at to assess the loan eligibility. In essence, falling interest rates create a more favorable environment for syndicators. The lower borrowing costs can help improve the deal and the deal structure and investor returns. It can also make it easier to refinance existing properties at better terms, freeing up equity for new acquisitions or property improvements, for example. 3. Rental rates and demand dynamics. And what about rental rates? When interest rates fall, more people may consider buying homes because mortgages become cheaper. This can reduce rental demand in some markets. However, in many urban and high demand areas, falling interest rates don't necessarily mean a mass exodus of renters to home ownership. It can actually increase demand for rentals because lower rates make multifamily development more feasible, leading to newer, higher quality rental properties entering the market. In some markets, if new supply of rental units enters the market too quickly due to cheaper financing, it could lead to softer rental growth or even a slight dip in rents as landlords compete for tenants. But in more supply-constrained markets, rents could still rise, supported by population growth and strong employment. For syndicators, understanding these dynamics is crucial. In a falling interest rate environment, the focus might shift to adding value through renovations or repositioning assets rather than relying purely on organic rent growth. Syndicators need to carefully analyze local market trends and ensure they're not overestimating rent growth in their projections. So what does all this mean for you as a multifamily investor or syndicator? Falling interest rates can create a favorable environment for purchasing and refinancing, but it also requires a strategic approach to property selection and market analysis. You need to know when to buy, how much to pay, and what kind of returns you can realistically expect. To sum it up, falling interest rates can be a golden opportunity for multifamily syndication. Lower borrowing costs can boost cash flow and investor returns. But it's essential to be cautious about market saturation and rental rate dynamics. The key is to stay informed, be adaptable, and always be ready to pivot your strategy as the market evolves. Thanks for tuning in. If you found this video helpful, don't forget to hit the like button and subscribe for more insights on multifamily investing and syndications. Drop a comment below if you have any questions or topics you'd like us to explore next. Until then, happy investing